Bollinger Bands look complicated on a chart. Three lines constantly expanding and contracting around price. But the idea behind them is actually one of the simplest in technical analysis. I'm Isiah from the Investor Center. This is episode 2 of our indicator series. Last time we covered ATR, which measures volatility as a number. Bollinger Bands do something similar, but they show it directly on the price chart. Here's how they work. So, three lines, let's break them down. The middle line is just a moving average. By default, it's a 20-period moving average, which means it's showing the average closing price over the last 20 candles. Nothing more complicated than that. The upper band sits above the average. The lower band sits below it. Both are set to 2 standard deviations away from the middle line. Now, standard deviations sounds technical, but all it really means is how far does price typically stray from the average. The bands are essentially drawing a boundary and saying based on recent history, price usually stays within this range. So when you look at Bollinger Bands on a chart, you're seeing 3 things at once: where the average price has been, and how far above and below the average price has typically been moving. That's the entire concept. Once you understand what the lines are, reading them becomes fairly intuitive. When the bands are wide apart, volatility is high. The market is making bigger moves and price is swinging further from the average. When the bands are narrow and tight, sometimes called a squeeze, volatility is low. The market has gone quiet. If you watched our ATR video, this should sound familiar. Wide bands and a high ATR are telling you the same thing, just in a different visual format. That's why these two indicators pair well together. One gives you the number, the other shows you the shape. Now, here's where people get tripped up. When price touches or crosses the upper band, it does not automatically mean it's about to reverse, and the same with the lower band. What it means is that price has moved further from the average than it usually does. It's stretched. That could lead to a pullback, or the market could just keep going. The bands aren't giving you a signal, they're giving you context about how unusual the current price action is compared to recent behavior. So why are Bollinger Bands one of the most popular indicators on platforms like TradingView? Mainly because they sit directly on the price chart. You don't need to look at a separate panel underneath. You can see the relationship between price and volatility in real time on the same visual. Most traders don't use Bollinger Bands on their own, they use them alongside other tools to build a broader picture of what's happening. Which indicators pair well together is something we'll be covering later on in this series once we've explained all the main ones individually. If you're finding this series useful, subscribing genuinely helps us keep making these videos for you. Let us know down in the comments which indicator you'd like us to break down next. So far, we've covered 2 volatility indicators, ATR and Bollinger Bands. Next up, we're looking at something different. RSI, the Relative Strength Index. It doesn't measure volatility at all. It measures momentum, and it's one of the most widely used indicators in trading. That's coming soon. I'm Isiah from the Investor Center, and we'll see you in the next one.